So let's talk about this bonus depreciation. There appears to be some rumblings that they may want to go back for some period of time, go back to 100% and maybe even retroactively. Sometimes you don't take the bonus depreciation, right? It's actually sometimes beneficial part of the tax planning that you take it over the 27.5 or whatever. That way you can offset your income and the new income coming in, right?
Especially when it comes to bonus depreciation, probably 60% of the states in the country don't follow the idea of 100% deductibility of bonus depreciation. I have to review the operating agreements by law. That's just something I have to do. So I would rather do it when you're drafting it so that I make sure that it's accurate. It's a lot easier to fix it before you send it out to 100 people than it is to do it after. I'm all about how can you serve your LP investors, because the better you take care of your investors, the better you're going to do, simply because they're going to continue to be return investors. And so if you can keep them informed and make sure that they have all the information they need so they can plan proactively, then happy investors.
So talk a little bit about the importance of being proactively planning versus just handing your CPA a bunch of receipts and say, hey, go get my taxes and K1's done. It's an election year. Do you think that helps or hurts? All right. Well, welcome. I'm super pumped to have my good buddy, Tim Gertz of Provision. Not only is he an amazing CPA, he happens to be my amazing CPA and my firm's amazing CPA. So he does all of our taxes on my personal side, but also on the firm side. So super pumped. He's a wealth of knowledge. He represents a ton of syndicators too. So it's not like he just does general tax and maybe dabbles in real estate. What percentage do you think of your practice, Tim, is syndicators?
50%.
Yeah, 50%. There you go. So anyway, Tim Gertz, for those that do not know who you are, you want to do a little bit about your background so people know your credentials, which are impressive. I know the credentials, but maybe to let the folks know how long you've been doing this and how it all works.
Yeah, definitely. Going on about a quarter of a century in public practice. So, which is hard to say. But anyways, I'm getting old. And you've been doing this for about 25 years, always working with high net worth individuals, closely held businesses, entrepreneurs. Working on proactive tax strategy is really, really my goal, is working with my clients and being a team member to help them throughout their entire life cycle. Whether they're a syndicator from inception of a deal through the end of that deal, or an individual that's starting a business, really working through and educating them on how to set up that business, structure that business, be as efficient in that business as possible. So
cool. And how do you get involved with syndicators? I know that's a big part of your practice. It just evolved that way, or
kind of fell into it. So syndication is really just partnership taxation. So, doing syndication is really just just being involved and educated in partnership taxation. So I've always been involved with trust and partnerships. That's always kind of been a little bit of a niche market for me. I stumbled into syndication probably in about 2015. Started working with a client that then led to more clients and really I enjoy it. It's kind of one of those things that I get to be able to work with someone and help them be the best that they can for their investors, and really help them, into that fiduciary role that they should be, looking towards as a syndicator.
Cool. Well, thanks, Tim. Let's get right into it, because I know you and I have been talking about this for years now. So I know you've got your pulse on it. And I was just reading some more rumblings about it last week, actually. So let's talk about this bonus depreciation. I thought that it was not all gone, but last year it started phasing out. So this year, instead of being 100% depreciation, you got 80%, and supposedly next year, right? I'm sorry. So that was 2023. So now in 2024, supposedly it goes down to 60%.
Correct.
But there appears to be some rumblings that they may want to go back for some period of time, go back to 100% and maybe even retroactively. Is that, can you bring us up to speed on how this all works and why that's even being considered?
Okay, so in tax law, there's permanent provisions and there's what are called sunset provisions. And bonus depreciation, there's a bunch of them. It's basically, it's a provision that allows them to over time phase it out, and therefore they don't need to balance the budget on it. They don't need to to peg it to the deficit, or it won't increase the deficit. And so This is a sunset provision. It came out of 2002. It's been kicked down the road over and over and over and over again. Ever since about 2021, there's been this discussion on the big three. The big three are research and development credits, bonus depreciation, and this business interest deduction. Those are the things that they've continued to try to work through and extend, or you've heard of these things called extender bills. They tried to do an extender bill in 22, it failed. They tried to do an extender bill in late of 23, it failed. They just did a stopgap bill late last week that they're going to be voting on this week that's going to keep the government running through March, I think March 8th or some nature, so that they can have more time to try to figure this out. So it's something, the big issue, and I could go way back into kind of what the issues are with it, but one of the biggest issues that they had is the CARES Act created this thing, called employee retention credits. They've been in the news a lot. Everyone's used them. What ended up happening is they got abused, and there was a lot of fraudulent claims. So at the end of September, I believe, they shut down the processing of these claims. And the issue that we're having right now is that these extenders need to be funded. So if they want to extend these bills, they need to be able to fund them. And the problem is they have such a huge deficit from the ERC credits that were fraudulent that they're trying to figure out how to effectively create the payment of these extenders. And so do I think we're going to see something this year? I hope so. But, I hope so in 22 and 23 and now 24. So,
And is there rumbling that they would retroactive that, or would that just be now starting in 2024? If they change the rule in 2024, you go back to 100% or whatever they decide?
It typically, yeah. It's going to be from date of inception, either from the date of signature, or they will retroactive it to the date of the drafting of the bill.
And so this is something you think is going to happen, if it does happen pretty soon, early 2024, because they're working on it, or is it could just be whenever? We don't know.
I have no idea. I mean, honestly, they everything I'm seeing is there's more traction this year. So there's more bipartisan approach towards it. It's always been bipartisan, but there's always been some sticky parts to it that has kind of squashed it or killed the bills. So they seem to have a little bit more motivation this year.
Do you think the fact that it's, I think somebody was asking, Paula was making a point that it's an election year. Do you think that helps or hurts?
I think it helps.
Yeah.
I think it helps because if they can get those type of things through, one of the sticking points has been the child tax credit. The child tax credit was supposed to increase, and it continues to kind of get pushed down. That's been one of the sticking points of one of the senators, is he wants the child tax credit to be $3,000 per year, where it's $2,000 right now.
But won't if they bring back bonus depreciation, isn't that going to mean less revenue for the government theoretically? At least in the short term?
They have to figure out how to pay for it.
Yeah.
So, and that was kind of one of the things with I think I read the total cost of bonus depreciation of these big three was about $685 billion. So they've got to figure out how to pay for that $685 billion. And they start doing it by phasing things out. One of the biggest ones, actually, the biggest driver isn't bonus depreciation. It's the research and what they call experimental credit. It used to be called R&D credit. That after 22, you used to be able to take the credit and also write off the expenses. Now you can't write off the expenses. You have to amortize them. So that was a big revenue generator. And that's one of the things that they're trying to go back to being able to write off. But that's about half of that $685 billion. So, I mean, that's the biggest problem. And the biggest elephant in the room right now is the ERC credit.
I just thought of this before I get to my next question, you told me, I mean, the conservation easement went away, right?
Correct.
So didn't they save a bunch of money there?
I wouldn't say they saved a bunch of money there. They limited it. So ultimately they limited the easements to 2.5 multiples, but there's still, an easement falls under a certain code section 170H, but there's also what are called fee simple arrangements that fall under 170A that have now kind of taken hold, and people are utilizing that.
All right, cool. So I'm definitely gonna ask you what your biggest mistakes, top three. I want to get your top three mistakes that syndicators make when it comes to their tax planning or the way they do stuff with their CPAs. But before I ask you that, the one that I wanted to address, because I think this might be a good time for my CPA joke, Tim. The standard joke that you ask three CPAs the same question, you get five different answers. That's my standard CPA joke, which I know can apply to attorneys as well. So let's talk about this idea of the bonus depreciation based on the amount of your carried interest, right? So a lot of sponsors were saying, hey, it's an 80-20 split. Even though if I didn't put any money into the deal, I own 20% of the deal, so I should get 20% of the depreciation. And a few years ago, the word was getting out that that's not the case. And now there's actually some splitting of the hairs where even if it's a recourse loan, sometimes I hear, well, that counts, that doesn't count. So let's talk about that. Let's just take a standard syndication, nothing fancy, 80-20 split, right? I raise a bunch of money. I give 80% to the investors. I keep 20% for my sweat equity, the carried interest. And let's say I don't put a dime into the deal. No, I don't, no money of my own. I just take 20%. Can I then take 20% of the losses in that syndication, including the bonus depreciation?
Technically, yes. It depends on how your operating agreement is written. And if your operating agreement is silent, then it's based, all profit and loss is allocated based on membership interest under the tax code. So you can, but what ends up happening is you find yourself in a situation where now you're relying on the debt to take those losses. And you've got your limited partners that put in, let's say, $10 million, that they're getting $8 million of loss. They have $2 million of capital, and you've taken $2 million of loss, and you're using the qualified non-recourse debt to do it. And so then you've got to be careful on the debt and how the debt's structured, because if it's not qualified non-recourse, then you are allocated losses, but you do not have the basis or the at-risk basis to be able to take those losses. So technically, could you do it? Yes.
Do you typically recommend doing that, or is that just a huge risk on the sponsor's side?
I typically, for me, how I think about it is the long-term maintenance of your investors and building that relationship with your investors. And this idea of economic risk of loss. They put $1 in, they've got $1 of risk. You've put nothing in, you have no risk. And so ultimately, the losses should be allocated to the individuals that have the risk of loss. And that's typically how most are done. Most operating agreements are written in a way so that the losses are allocated until the capital accounts are exhausted. And then at that point, it's pro rata based on membership interest. And what that's doing is basically saying, hey, investor, you gave me $1. We have $1 of loss. I'm going to give you that loss so that now you have no risk of loss anymore. And then at that point, we're going to allocate based on 80-20 principle.
But I'm not required to do that by law. I can literally set up my operating agreement that says, hey, even though I didn't put any money, I want to take 20% of the loss from day one, and I'd be able to take that even if I have no economic risk of loss.
Correct.
Cool.
Yeah, and if you're silent, if your operating agreement is silent, 704, which is the tax code for partnership allocations, specifically says it's based on membership interest.
So if you wanted to change that, you want to make sure the operating agreement matches. Probably one of the reasons, and I always recommend this, but syndicators probably should be sending their operating agreements to their CPAs prior to raising. Let's talk about that, because I know that's
number one mistake.
Number one mistake. All right, there we go. Number
Mistake.
one mistake is not bringing in your CPA early in the process. Meaning, once we're done drafting the docs, not having your CPA review the entire operating agreement or just the section on tax?
I mean, the section on tax is definitely the number one and what we're going to focus on. But I do review the entire operating agreement to make sure that there's nothing that jumps out, definitions that are a little wonky. But really, number one is the second you start, I mean, even from a structuring perspective, I want to be involved when you're putting the structure together, especially on the size of the deal, what you're doing. Do you have an SBE in there? A Delaware SBE because of the size of the loan? Where are you? Are you in Tennessee? Are you in Texas? Do we want to do LPs? Do we want to consider even doing maybe a membership interest purchase agreement if you're in a jurisdiction that has excise tax or has the ability to carry over assessed values? But yeah, I mean, that's the number one mistake is for me getting a packet of information when it comes time to do the tax return and seeing that the PPM does not align with the operating agreement or does not align with the intent. A lot of times I have conversations with syndicators of, was this the intent? And, you know, if that was the intent, great, but was it the intent because your PPM says something different?
And how long does that take you? Because I think that's the biggest hang up for sponsors, right? When I'm working with sponsors, they want stuff yesterday, right? Because they need to close, they need to raise the money. If they can send you if they can send you and I say you, when they can send their CPA the operating agreement and then get it back tomorrow, no problem.
Yeah.
But that's usually not the case, right? Especially the time of year. So I think that's the biggest hesitation with one. Like, how long should it take if you send the operating agreement to let's talk about provision. So send it to the provision. Typically, how long are you spending before you can get those comments back and I can move forward with my capital raising activities?
I think it depends on who the attorney is. I mean, if it's if I'm working with Premier, I've worked with Premier for what, 15 years now.
Right.
I've been involved with hundreds of deals. And so, for me, I can look at a Premier operating agreement and turn it around in a matter of, 30 minutes to an hour.
Right.
In most cases, I mean, we review part of our due diligence and part of our, ethical responsibilities is to review operating agreements on partnership, without reviewing the operating agreements, we should not be preparing the tax returns. And so effectively, I'm looking at hundreds of operating agreements every single year. So to get through an operating agreement and a PPM doesn't take too long, especially if I'm focusing only on the tax aspect. But you shouldn't be looking at a week turnaround. You should be looking at, a day, maybe two at most.
And the cost presumably isn't crazy either. Then if you're spending an hour or two on it or something, even it shouldn't be crazy.
No, and typically how we structure our is we bake it into the first year tax returns. And so essentially we add about $1,000 for the first year and $1,000 for the last year. And that includes meeting with the attorneys, structuring, reviewing the PPM, the operating agreements, getting everything set up and dealing with it. So, really that's baked into the cost because I have to review the operating agreements by law. That's just something I have to do. So I would rather do it when you're drafting it so that I make sure that it's accurate.
Yeah. For those of you guys that work with us, Tim's actually, I think it was Tim originally, or Provision for sure, is the one that actually drafted the section in our company agreement that has all the initial tax sections anyway. Obviously, you want to send it to your CPA as well to make sure that they're in agreement. And they're not always in agreement. They may come back and say, hey, I want to change this provision. But generally speaking, the attorney is not going to change the tax language of an operating agreement just because we're not sufficiently qualified to do that. And that was one of the questions that Paula brought up, which is, so the attorney writes the company agreement, the GPs review and revise it, or really the GP review, give comments back to the attorney who can then revise it. And then it should also be sent to the CPA before signing, ? I think that's right. I think you want to see it when you think, the way I think of it is, I think you should send it. Tell me if you agree or not, Tim. Sponsors should send the operating agreement to the CPA almost like as an intercept right before you want to send it to your limited partners. Before you send it to limited partners, send it to the CPA because the attorney's already drafted it, reviewed it. They're good with it. But before you send it to the LP, send it to your CPA to take a look at. And if there's obviously any changes, it'll go back and forth with the attorney.
It's a lot easier to fix it before you send it out to 100 people than it is to do it after.
100%. Anybody got any questions about that or anything so far before I move on? Or are we counting that as a top mistake? Number one mistake?
Yes.
Paula, go ahead.
So that means that we're not signing it until the CPA sees it, because I don't want to send out something or share that if we're going to, that would make us have egg all over our face if we're going to be doing this twice. We need to have an order.
Yep. Yeah. Typically when I work with clients, it's number 2 in the step. So effectively they go, I guess it's number 3. They've identified the property, they've got an LOI or whatever it might be. And then they start the structuring with the attorney, and then I'm next in line, or we're next in line. And basically it's just kind of, can you give me your blessing that this is okay before we send it out? Typically I do it before they do webinars or they send it out to their investors, whatever it might be. But it's a lot harder to do it after the fact when you've got people that have already signed the documents and you have to go back and amend those documents. And it's a
So
lot
it's
easier
better to do
not.
it before you sign.
Yep.
In all cases, I would say, because you're taxing with a portfolio in mind. And
Yep.
thank you.
Yeah, changing it afterwards, depending on how the operating agreement is drafted, may require everybody's approval, right, or a majority of all the investor approval. So you definitely want to do that beforehand. By the way, a little quick promo, because I'm going to add this actually to my presentation. I'm doing a presentation on Wednesday for new. If you've never raised capital before, you're a new syndicator. I'm doing a little 60-90 minute little live, kind of going through the legal, and I'm gonna add this to that process. If you guys want to get an invite to that, just maybe drop something in the chat or something. Just say, I don't know, new. If you want me, and I'll send you an invite. That's gonna be Wednesday, I think at 10 o'clock. But okay, cool. So that's the number one mistake. Give me another top mistake syndicators are making these days when it comes to the CPA stuff.
Thinking that property management reports are actual financial statements.
Wow, I just saw a post about that today, and it wasn't you, by the way. So that's interesting. So unpack that for us. So people are sending you. So sponsors get their property management reports, and then they just turn around and send those to you and say, "Go prepare my taxes."
Yep.
And why is that not good enough?
They're cash flow statements. So they don't necessarily, they might, they're good for the health of the, health of the property. They know, cash in, cash out, but they're typically only focused on the profit and loss side or the income statement, not on the balance sheet side. So the property management company, you might get a good one that's doing the amortization of the loan, interest, and, principal. Most of these are interest only. But they're not really keeping track of CapEx. They're not properly allocating CapEx to capital or repairs and expenses. They're not keeping track of depreciation. They're typically 99.9% of the time, you've got what are called off balance sheet bank accounts. You might have a holding bank account that is underneath the LLC that the property management company does not have any access to. That is one that you typically are paying the distributions out of. You might be paying CapEx out of that. You might, it's where the money comes into, and then ultimately was utilized to purchase the property. And so that's a lot of the times when we get cash flow statements from property management companies, there's a lot of discrepancies, and we have to do a lot of work to try to figure out what those discrepancies are. I think, if, again, going back to the fiduciary role, if you're managing people's money, you should be able to tell them what that money looks like on any given time. And without having a true set of financial statements, you can't do that.
Oh, bank accounts. You talked about bank accounts.
Yeah.
Do you care? Let's do it. Two questions. One, purely from a CPA tax standpoint and maybe best practices, but like, how many bank accounts do you think a sponsor should have when they're owning a building? Do you have any, do you care, or do you just want to make sure you have all the statements from all the banks?
I don't necessarily care. I just
Yeah.
want to make sure. A lot of times what I see, and this is a lower down issue. And it might not be something that is very often, but I've seen a lot of larger syndications that have a common holding account. They might raise capital and put it all into one, and then they filter it out, not a fund to fund or anything of that nature. And that's a big no-no. Because what that does, maybe, I'm not talking from a legal perspective, but from a tax perspective, that leads to a lot of potential errors and a lot of audit risk. Because if it was ever to be audited, not to say it would, but if that was ever audited and we had to provide those bank statements, that would open up every single syndication that was underneath that umbrella to audit as well.
So in your mind, you should have just the one bank account that's owned by let's call it the syndication LLC, the main company.
Yep.
Okay. Yeah, and I think from a legal standpoint, or maybe it's best practice, I think from a legal standpoint, you also you want to usually segregate your operating account from your reserves account, probably at a minimum, just to make sure that you're not tapping into your reserves or anything you've set aside for value add or whatever. You don't want to have that caught up in operations. But I want to know specifically about the CPA. You mentioned audit risk too, Tim. What does that look like these days? Is it odds of getting audited? Are there some red flags that pop up that would prompt it, or overall is it pretty low audit risk like most companies?
It's pretty audit. I mean, a partnership is one of the least likely to be audited. So the numbers, I mean, even I think the rate is like 99.9% chance of not being audited. There's about a 0.1% chance of being audited even on your individual tax return.
Cool. I don't know. I told you this before. I'm a little spacey today. I don't know what's going on. It's Monday.
It's the weather.
But I am spacey today, and especially now that I've got to like multitask and look for questions here. But
Not enough caffeine, Mauricio. Not enough caffeine.
I think I need some more coffee. I don't know what's going on. Paula, you got a question about separating holding company accounts?
Just a point of information for clarification purposes. So we're separating operating accounts from holding accounts. And we're also making sure that each are separate for ventures. We're not collecting monies in one holding account for more than one venture. And then also, someone mentioned different banks. Is it important for us to have those different accounts in different banks? And if so, why?
I don't necessarily have a comment about banks. I don't think it really matters in this case. The only time I just kind of a little side note, the only time I insist on a particular bank, it's not even a particular bank, it's really the location of the bank, is if you're setting up your structures for asset protection purposes, and let's just say you create a holding company, right, just for your own personal in Wyoming, or it doesn't matter, Wyoming, Nevada, Delaware, any of those great states, you don't live there, right? So let's just take Wyoming, for example. You don't live in Wyoming. So you are looking to create as much connection with the state of Wyoming as possible in order to avail yourself of those laws. Because what you're trying to avoid is somebody say, well, Mauricio, you live in California. You've got nothing going on in Wyoming. We're going to use California law instead of Wyoming. I'm like, no, I want to use Wyoming law. That's where I set up my company. So the more connection you have with that state, the better. And one of the easiest way to get a connection is set up a bank account in that state. So if I was setting up a holding company in Wyoming, I would go actually get a bank account in the state of Wyoming and opening there. Same thing if I wanted to do in Nevada. For me, it's actually easier for Nevada because I can drive across state line, but actually open up the bank account in Nevada. Next step, of course, would be have some kind of a physical address or some kind of, again, you're just trying to create the most amount of nexus. But from a syndication standpoint, none of that really is applying because your syndication LLC is not really there too much for asset protection purposes. You're going to set that up in whatever state, the property is located. Jeff, I didn't have any wine last night, and I don't watch football, so but that is a good assumption. I will say that is a great assumption that I drank too much wine watching football last night, but that is
Mauricio, what is
that
the
is
I figured you were
purpose of
whining because of LA Rams losing to the
dude, I couldn't care. I'm basically like football season started, like that's where I'm at. Like but anyway. Sorry. Okay, so Tim, let's talk about the third biggest mistake you see. And then I do want to spend a little bit of time on, because I know I got you for another maybe 15 minutes about some strategies people can take, whether it's for their syndication or otherwise, that they can still take today, even though we're already into the next tax year before taxes are due. But give me one more of the big mistakes that syndicators make when it comes to the tax prep.
It's a pet peeve of mine. And it might not be a mistake, but not giving proper information to your LP investors when you sell a deal. So not providing them with a gain calculation, not giving them the information of what they need to do from a tax planning perspective. We're proactive tax planning firm. So everything we do is trying to plan for what's happening. And if we don't have that information, then we can't provide that service. So that's a huge pet peeve for me and something that it's hard. Again, I'm all about how can you serve your LP investors, because the better you take care of your investors, the better you're going to do, simply because they're going to continue to be return investors. And so if you can keep them informed and make sure that they have all the information they need so they can plan proactively, then it's happy investors.
Let's talk about that too, Tim, because that's one of my favorite things to talk about when it comes to having a CPA or a tax firm like yours. And that is the difference between simply preparing your tax returns and actually tax planning, right? The analogy of, are you looking in the rearview mirror, or are you actually looking forward to kind of plan and how to minimize the tax? Because you and I talk about a lot of times clients will reach out to me and they're like, hey, I just sold this thing. I had a huge gain. What can I do? And Tim and I always laugh because it's always like, no, that was something we should have discussed 5 years ago when you bought the asset, right? So talk a little bit about the importance of being proactively planning versus just handing your CPA a bunch of receipts and say, hey, go get my taxes and K1's done.
Typically after December 31st, it's hard to do anything. There's some low hanging fruit that you could potentially do to save you taxes on your prior year, but everything's about being proactive and, really looking at not only what's happening today, but what's happening next year. A lot of the discussion I had with clients this past year was, where are we today and what are we going to do next year? What's our goals with next year? Because a lot of people were, kind of sitting on the sidelines in 2023, not investing, not doing a lot, generating a lot of capital, but not deploying that capital. So, if we don't know where we're headed, we can't plan for it. And so that's a lot of the discussion we have with our clients is, what's your intent? Where are you headed? Where are you going? What are you going to do with this? Because there is opportunity in just looking at the tax rates. Marginal tax rates go from 0 up to 37%. Capital gains tax rates go from 0 up to 20%. So if we can effectively plan for those different levels, I talk a lot to people about, there's this misnomer, and people probably hate me for it, but this idea of paying no tax. If you pay 0 tax, you've lost out on lower tax brackets and you've lost out on credits and deductions. And so my goal is to be as efficient as possible and to kind of have you in this little pocket where you've taken all the 30% tax brackets and you've gotten the deductions at 37 cents, 35, 32%. And we've been able to take the lower tax brackets, the 10s, the 12s, and the deductions and credits. And yes, maybe we're in this like 20% tax bracket, but we've gotten the biggest bang for our buck. And we've been able to utilize the credits and, capital gains. The first 90,000 is taxed at 0%. So there's a lot you can do with it if you're always proactive with it. If you're always looking backwards, we can't really do anything.
Yeah, that's something that I had to take me a while to get used to. When you're like, I want to pay 0 tax, like, no, we want to get you down into this level so you can get below this number and we can take advantage of stuff. The other thing you and I talked about a while ago too is on this bonus depreciation thing as well. It's like, it's not necessarily true that you want to take, and now I'm talking more individual than syndications, but sometimes you don't take the bonus depreciation, right? It's actually sometimes beneficial part of the tax planning that you take it over the whatever it is, 27.5 or whatever. That way you can offset your income and the new income coming in, right?
Yeah. Or even, with cost segregation studies before, bonus depreciation has been around since 2002, but it was always on first used assets. So it wasn't on used assets. 2017 created this idea of being able to utilize it on used assets. Prior to that, we would use cost segregation studies and we put them in service year 3, year 4, year 5. And we would basically create bonus depreciation by pulling all of that deduction into 1 year. Same thing with, currently, hey, maybe on an individual level, we don't need that deduction because that deduction is going to put us in a position where we lose out on this, that, and the other thing. So maybe we don't do a cost segregation study in year 1, we do it in year 2. Or maybe we wait until year 5 and we do it. And, as bonus depreciation is phasing out, that's going to become more and more prevalent, where we're going to start looking to do cost segregation studies and putting them in service in year 3, 4, or 5 when you have a large sale, when you have a large income event, so that we can take that deduction in that year and essentially not lose out on the lower tax brackets in the prior years.
I don't know about this, Tim. Do you know anything about this New York and Alabama laws? It said, let's talk about the state of New York and Alabama. Paula says, this is the first year I received an unknown bill for taxes for a bill owed due to LP ownership in a company that invested in New York. How do CPAs plan for that extension? You know what you're talking
We
about?
don't know. We can't plan for it. You know, there's this idea of decoupling. So states, California is one of them. California basically doesn't follow Fed at all. So they decouple from federal tax law. New York is also one of them, especially when it comes to bonus depreciation. I would say probably 60% of the states in the country don't follow the idea of 100% deductibility of bonus depreciation. And so, yeah, you do have this issue where you could be in a state, whether you are a resident of New York or if the assets in New York or Alabama for that matter, where from state law, you don't have that deduction. So you might have taxable income, but federally you're going to be in a loss perspective. So it's hard. I mean, it's hard from your CPA's perspective. If they don't know where these assets are and what you're investing in, they can't plan for it. And, you know, New York is one of those states, in New Jersey, Pennsylvania, where they want you to pay in 80%. And if you don't pay in 80% by April 15th, they don't accept your extension. So now you've got late filing penalties and et cetera, et cetera. You know, there's some overarching, far-reaching states that, you know, New York, New Jersey, PA, that says that if a syndication has a owner in that state, they have to file a partnership tax return in that state. So let's say you have a syndication in Texas. Everything's in Texas. You've got situs in Texas, the property's in Texas. If you have a LP investor that is a New York resident, you have to file a New York partnership tax return. And they can come back and go after you for that and say that you should have filed a New York state tax return, and they can penalize the syndicator for that. There's a couple of states, New York, New Jersey, PA. There's a couple other ones that are far reaching in that regard.
And California's on there too. I don't know about the tax part. Are they far reaching? I know that on just for registering to do business in California, they take the position that if you have a member that is an owner of the company, then you are by definition doing business in the state of California, which is ridiculous, but it is what it is. Like, you can find it ridiculous, but unless you're going to go spend $100,000 to go fight them in court somewhere, which nobody does.
And you'll yeah.
I want to go into things that we can do today that will still save us from taxes, even though 2023 has come and gone. But before I do that, I just remembered I've been talking way too much, and I think I'm going to slow down a bit. I've been talking way too much about this Corporate Transparency Act, which I get a lot of kickback for. Does that affect you guys at all? Is there anything that's changed in your world due to these filing requirements for these entities?
I mean, we hit the ground running when that came out and everything, and we were coming up against the deadline as far as 2024 being the year that we have to do it. Our regulatory body basically came out and said we can't touch it. So it's akin to practicing law. So we really don't have anything to do with it. Unfortunately, we're not necessarily allowed to touch it, because then it could be construed that we're practicing law illegally.
Did you guys file any entities in the past, or you never filed entities? Okay, because I think some CPAs do file entities. That's why I was wondering.
They do doc prep work and stuff of that nature. Our thought process on that is we're not attorneys, and attorneys should be the ones that do legal work. We're CPAs. So, it depends on the state that you're in. Some states allow CPAs to do that type of work and legal formation and doc prep work. And I think it's dangerous. So we don't touch it.
Yeah. And I'm done. I mean, I literally have now decided we actually are outsourcing all of our entities. It's just too much of a pain for us, liability for us. We're like, forget this. We're gonna partner with somebody else to do all of our entities now.
Yep.
All right. A few minutes left, Tim. Give us maybe the top 2 or 3. Let's start with the number 1. What are some of the strategies you guys are recommending? 2023 has come and gone, but there are some things we can still do, right? That we can potentially reduce our tax bill for last year.
I mean, there are a couple things. Retirement accounts is always the big one. Secure Act couple year allows you to now create that retirement account after the year end. So you have until April 15th to create the account. You can fund the account until the filing deadline, or you file your return, whichever is first. That's kind of one of the things you can do. Kind of other things, cost segs are huge. If you've got an asset, do a cost seg. You have until the filing deadline to do that. R&D credits, again, if you have a business that might do research and development work, you can do that after the year. One of the big things that might not give you a federal tax deduction, but will provide you some benefit, is the idea of pass-through entity tax. That was something that came out of the 2017 Tax Act that disallowed the deductibility of state taxes. So itemized deduction now, state taxes are limited to $10,000. You live in a state like California, you get to that threshold very, very quickly. Most of these states have now enacted what are called pass-through entity taxes. So you get to actually deduct the tax you paid to the state on your federal return. Something to look into. If your CPA hasn't talked to you about it, ask them that question. What about pass-through entity tax? Can I take it? How do I take it? California, of course, is funky. You have to actually make an estimated tax payment by June 15th of $1,000. And if you don't, it doesn't qualify. So you're too late, Mauricio, unfortunately. But there's a lot of other states that allow you to do it after the fact. You can do it all the way to March 15th or April 15th. So
we've talked before on the pod about, home office deductions and even paying your kids. We talked, I think, a couple episodes ago about how to pay kids. Is that something you can do retro? Like if somebody just found out today, hey, I could have paid my kids. I gave them a bunch of money last year for free, or is there allowance or whatever? Is there stuff that is it possible for you to sort of recategorize some of that gifting of money and say, wait a minute, let's call that payment, or is it too late at this point because they haven't done the work?
It depends. So home office, yeah, definitely you can do that after the fact. Paying your children, it depends on, we're coming up on the January 31st deadline. So it depends on your structure, whether or not you can pay them through payroll, whether or not you have to do Social Security and Medicare. If you pay them a 1099, you just need to, do the reporting. So you paid your kids $10,000. You gave them a gift of $10,000 for services, that are helping you in your business. Well, if you can actually categorize that as a deductible expense because they were doing work for you, you just need to make sure that you file the appropriate returns, whether it's payroll tax or 1099s.
Yeah. And I think Jeff was clarifying the cost segregation. Let's get clarity on that, because I know that comes up all the time. But so the question is cost segregation can be done up to the filing date of March 15th for 2023 taxes or April 15th?
It is extended due date. So if it's an entity, it could be all the way to 9/15. If it's your individual, it could be all the way to October 15th.
And that's the year that the asset was placed into service, right? Not necessarily is it the year that you purchased the asset, or the year that the asset was placed into service, or does that not even matter?
It doesn't matter. So if it was a 2023 asset and it's in a partnership, you have until September 15th of 2024 to do that cost seg and get it reported on the tax return. The one caveat, and I know we talked about this earlier, Mauricio, is if you need to make any amendments to your operating agreements for the prior year, if there's any changes that need to be done, that has to be done by March 15th. So as long as you have it done by March 15th of the following year, it can go in effect for the prior year. So as long as you need to make a change for the 23 tax year, it's made by March 15th of 2024 and signed, you're good.
This is me geeking out now. Does that mean that it has to be, do you have to make it effective 2023, or does that not matter as long as you sign it by March 15th?
As long as, so if you're trying to make a change from a tax perspective on an operating agreement for 2023, it has to be done by March 15th of 2024.
So I could sign it on March 29th and it could become effective March 29th, but then that counts for the change for 2023 purposes. Like you don't care exactly how it's worded as long as it's signed by the end of March.
March 15th.
Sorry, my bad. Sorry, March 15th. Got it.
Yeah,
okay.
the due date of the originally filed due date.
Got it. Adriana was asking about the child. This is interesting because she says when you say child, she's guessing it's 18 years or younger, which that is true, but this doesn't necessarily just extend to children. I mean, it's paying your relative. I mean, you could be paying your elderly parents, and you can still use that as a deduction, right? It's like I do.
If you're if you're supporting someone and they're performing services for you, and if you're just gifting them that money, figure out a way to to employ them and utilize their services and then pay them so you get a deduction. Typically they're in a lower tax bracket than you, so there's that arbitrage between your tax bracket and theirs.
Yeah, I mean, I do that with my father-in-law. So he's my little gopher, my personal assistant. Sometimes goes to the bank, does all these errands, and so I pay him out of the company. That way, it's a deduction to me, and he gets it too. But and then do most of your clients, and this is kind of not necessarily taxing, but just maybe in terms of a strategy, although it is, I guess, a tax. Do most parents who do the tax, who pay the tax, that pay their kids to take advantage of that, do they tend to put that money into IRAs from there? Because you can fund an IRA up to a certain amount, and what is it, 6,500 now, or $7 grand for a Roth?
Yeah.
Do most people do a Roth?
I mean, typically that's one of the strategies that we utilize or we educate on is that the threshold is 13. I mean, it indexes for inflation every year, but let's just say $13,000 of income is not taxed. So if we can take that and pay our children $13,000 for the work they perform, as long as it's within reason, the first 7 you put into a Roth, you've gotten something that's not taxed, that's going into a plan that will never be taxed. And they have flexibility to utilize that, because as long as it's in there for 5 years, once it's been in there for 5 years and effectively seasoned, then they can take the principal out without any penalties. They can use it for education. They can use it to buy their first home. They can utilize it for various avenues that they wouldn't be able to utilize if it was in a 529 plan or something of that nature. We also talk about, above and beyond that, maybe funding a whole life policy. You've got a child that's 10, 12, 13 years old, getting a whole life policy and using tax-free money to fund that and getting that, paid up so that they no longer have to fund it when they're in their 20s or 30s. And now they've got a whole life policy that's going to continue to grow that they don't have to fund.
Or you could fund vacations, right? I remember asking that
Yep.
many years ago, because I'm like, can I pay my kids for legit work and then put that money in their bank account and then have them buy their own plane tickets to Italy? I think it was one of the trips that we're going to go to Italy. And you're like, yeah. So it almost becomes like a tax savings, for travel expenses if you're going abroad and there's significant things. That's pretty awesome.
Yeah.
All right. Unless anybody's got one last GoFundMe for vacations. Paula would like you to come back every 2 weeks. Does that work for you, Tim?
100%.
You should reach out to him. But I'm going to put Tim's the website, Provision Wealth, down there. Paula did ask where you were, and I was going to say Tempe, but you guys just moved. So are you guys still in Tempe, Arizona? Or do you guys move over to Mesa?
We're in downtown Phoenix.
Or neither one. You're downtown Phoenix. Yeah, I haven't seen your latest office in a while. We do everything over the phone.
Yep.
Cool. Tim, what is the best way? I put your website there, provisionwealth.com. What is the best way for people to get a hold of you, and when should they get a hold of you, and when should they not get a hold of you? I'm guessing right around now is a pretty good time to get a hold of you, as opposed to March.
Anytime's a good time. Yeah. But the lag time goes up a little bit as we get closer to deadlines. March 15th is a big one for me. If you go to provisionwealth.com, there's a contact us link, and it just asks you for some information. And then ultimately an individual by the name of Ann in our office will get something scheduled, and we'll sit down and figure out how we can help.
Cool. And I put both links in the chat. So, Tim, thanks so much. I know we almost spent an hour. I really appreciate you taking the time out of your busy schedule to come help the community. Everybody give him a virtual applause. Thank you so much for coming, Tim. If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.